Those results from Adcock Ingram, profits up 11% for the 6 months to March. Your view on those numbers?
Yeah, the marginal increase in the profits I thought was fairly good. The revenue only increased 7% and their HEPS were up 11. It speaks to the margins that's increased slightly that Jonathan Lowe was talking about. I am a little to be hard on them, I am a little surprised it wasn't a little better. They do prefer a strong rand, and that's the environment we've had for the last 6 months. But I think it also speaks to just how tough that sector of the market has been. Consumer spending is very tight at the moment. We're only just starting to see a rebound in that, and it's not even a full rebound as it is. So I think under the circumstances, a reasonable result.
How defensive is a company like Adcock Ingram?
Well, market commentators like to look at defensive stocks such as pharmaceuticals, tobacco, alcohol, and so on. It doesn't. It's not affected during the different stages of the cycle as other more cyclical stocks, as what we'd called, such as furniture retailers and a few others. I think Adcock Ingram is fairly defensive, as you can see in those numbers, marginally up in this point in the cycle.
It hasn't been growing nearly as fast as Aspen, though, and Aspen really must be its main competitor in the market.
From an investment perspective, I think that's one of the problems. Adcock makes an interesting case. They are trying to position themselves through acquisition and organic growth in Africa. And I think what they'd like to do is partner with any other international companies that'd like to come into Africa. However, when you've got a big competitor within the market like Aspen, from an investment perspective, Aspen seems to get all the attention. So you generally find that the smaller stocks struggle to get the attention that they think they would be deserving of.
Another company out today with results. Brait, numbers for the year to March. Net profits also up 11%. Private capital's operating profits up 145%. So numbers look quite good in the face of it.
Numbers were reasonably robust. The assets under management dipped just a little bit. A lot of that, again, coming to the rand play, a lot of their assets are actually denominated in US dollar terms. And so their assets under management dipped just slightly on that. Their private equity division seems to be performing fairly well. At this stage in the cycle, though, a lot of the investments that they've made might be needing some additional capital. So we'll have to watch that and see how that develops.
Do you think now's a good time for private equity companies, though? Do you think that we could see a lot more kind of takeouts of listed companies by the private equity sector?
The heydays of 2006 and 2007 seem a fairly far distant memory. Ultimately, we are in a low interest rate environment, which private equity companies really enjoy. And as long as the valuations aren't too expensive on listed or non-listed companies, there'll be opportunities for them.
Kevin, how about yourself? What opportunities are you seeing in the markets at the moment, if any?
I think you have to be fairly defensive. The concerns that the world is having to digest at the moment are real concerns, and there's a lot of unknowns, such as the European banking sector that we were talking about earlier. I do think sovereign debt crisis is something we're going to have to navigate as investors for the next 3 years. And that doesn't mean that it's going to be a one-way bet. I think volatility is going to be fairly high. It all depends on what clients' time horizon is. Clients with a very short-term time horizon, I think you have to be exceptionally cautious. With a slightly longer-term time horizon, there's a case to be made for looking for opportunities, I think.
Of course, we have seen our market coming down about 15% from the highs we hit in April. So we were up at 29,500. We're now barely above 26,000. I mean, do you think there are buying opportunities at this stage? Do you think you'd still be a little more cautious in case there is a further pullback?
I think you do have to be cautious. A lot of people have been trying to draw parallels between now and 2008, and with the bailout that Europe put out 3 weeks ago at 750 billion euros, they viewed that as the post-Lehman response that we saw. You know, with the context of the massive amounts of sovereign debt that are still outstanding and how the world has to navigate that over the next 3 years, we could, coming back to that 2008 analogy, we could be in the Bear Stearns part of this crisis instead of the Lehman part, which means that there still could be considerable downside. Having said that, it doesn't mean that it's a one-way bet. I think if your time frame is long enough, I think there are opportunities now. 2 months ago, people were complaining there was no value on the market with a 15% pullback. Some of those stocks have done even more than that. I think you can start looking at making some investments. Yeah.